Technology is awesome. I use it all the time. Hell, I'm using it right now. At least it's awesome until it doesn't work. And that's what happened on this week's tax webinar for Does It Pencil. The audio died and I got none of it. So what you're going to see in this video is just my studio version of quickly recapping and recounting what we covered for this week's Does It Pencil tax-based webinar. If you haven't been to a Does It Pencil webinar, you can check it out at doesitpencil.com. Go to the link that says webinar, and we do them on Zoom every Friday morning at 9 a.m. Pacific, unless I'm teaching somewhere. Okay? So enjoy this. I hope it helps. The first thing that we talk about in Does It Pencil Course 3 about taxes is the 3 types of income based in the Internal Revenue Code. They're called active, passive, and portfolio. So active income is what you make from your job. It's your wages, your W-2, your 1099. The way that I talk about it is it's the money you make from your human labor. And the reason that matters is that income is subject to FICA tax, FICA, also known as Social Security. So that's the first type of income. Portfolio and passive income, I kind of group together. There's some minor differences, but the key feature of passive and portfolio income is that it's not subject to FICA because the Revenue Code does not recognize it as being coming from your human labor. Probably the most misunderstood part of the tax code that I ever hear from students and clients in Does It Pencil is the difference between a tax credit and a tax deduction. So when someone says, oh, I can write that off, usually what they're thinking is they're going to get a tax credit, but they're not. They're going to get a tax deduction, and the two are completely different. So let's say, for example, you pay tax at an effective rate of 20%, okay? And you buy something for your business that cost $1,000. You're writing a check for $1,000, but if you've paid 20% tax rate, you'll get a $200 benefit. What that means is net, that item still cost you $800 after tax. Now contrast that with a tax credit. If you bought something for $1,000 was eligible for tax credit, you would recognize all $1,000 of those dollars you spent as a deduction against income, and you would pay no tax on the $1,000, okay? So credits include things like the child care tax credit, the earned income credit. There's some tax credits for Section 8 housing. If you're interested in learning more about this, obviously look it up online or just talk to your tax person. Adjusted basis is a really important topic in tax code and in tax law. The reason it's so important is because you're always dragging around your adjusted basis with you until one of two things happens. You either sell or you die, okay? That's when gain is recognized. So the adjusted basis is calculated by the purchase price plus any cost of acquisition that you had when you bought it. Then as you go along, you subtract accrued depreciation and add the improvements, and that's what equals the adjusted basis. There's a provision in the tax code called a Section 179 allowance. This is a depreciation provision. And what it does is allows the taxpayer to fully recognize the cost of acquisition of an item for business in the year of acquisition. So let's say, for example, you bought something for $5,000 for your business. If you make the election on your tax return that year to treat that as a Section 179 allowance, you will recognize all $5,000 of those dollars against income in the year of acquisition, and then the adjusted basis of that asset goes to zero. Conversely, if you choose just regular depreciation, and I'm just going to use the straight line method because it's a simpler example, you would get $1,000 per year for 5 years. So in terms of the time value of money, more is better now. It's better to take all of it sooner, but the election take of 179 is a tax planning item. And again, you should talk about this with your tax person. So there are basically two kinds of tax systems in the United States, progressive and regressive. Progressive systems tax each subsequent dollar a taxpayer makes at a higher rate than previous dollars. So the federal tax system in the United States is what's called a progressive system. If a taxpayer makes $450,000, they're going to pay a much higher tax rate on that tier of dollars than, say, on $10,000. Okay, it's just a rate difference. A regressive system is different. In a regressive system, all earners, all taxpayers are levied at the same rate, typically on consumption. So let's say that two taxpayers both need $10,000 worth of stuff a year to exist. Okay, let's say that the levy rate is 10%. If taxpayer number one makes $20,000 a year, they're going to buy this stuff for $10,000 and they're going to pay $1,000 in tax on that. They'll have $9,000 left over. A $100,000 taxpayer buys the same $10,000 worth of stuff, pays the same 10% levy, will have $89,000 left over. So the argument is that regressive systems tax lower wage earners less favorably than high wage earners. There's a provision in the tax code called a Section 179 allowance. This is a depreciation provision. And what it does is allows the taxpayer to fully recognize the cost of acquisition of an item for business in the year of acquisition. So let's say, for example, you bought something for $5,000 for your business. If you make the election on your tax return that year to treat that as a Section 179 allowance, you will recognize all $5,000 of those dollars against income in the year of acquisition, and then the adjusted basis of that asset goes to zero. Conversely, if you choose just regular depreciation, and I'm just going to use the straight line method because it's a simpler example, you would get $1,000 per year for 5 years. So in terms of the time value of money, more is better now. It's better to take all of it sooner, but the election take of 179 is a tax planning item. And again, you should talk about this with your tax person. Depreciation is a really important part of the tax code. It's also kind of complicated, especially if you've never done it before. So here's a few talking points about depreciation with a little bit of emphasis on real estate. So point number one is depreciation is what's known as a non-cash expense. So what that means is you take it every year, you impute it on a tax return, but you do not write a check for it. Okay? That's what's kind of weird about it. It's something you just put on your taxes. It reduces your taxable income, which reduces your tax liability and allows you to keep more of your own money. Okay, it's a tax saving strategy. The second thing about depreciation, and this is a real estate item, is that land is not depreciable, only the improvement portion of the land is. So to calculate depreciation properly, you have to separate the land value from the improvement value, and we teach you exactly how to do this in Does It Pencil Course 3. The next point about depreciation in real estate is that all real estate, real property, is depreciated using the straight line method over 27 and a half years if it's residential and over 39 years if it's non-residential. And the last thing I'll leave with you about depreciation is that there's two different systems for depreciation, what's called the straight line method and the Makers or Mackers method. Straight line is used for real property. The Makers method, and Makers stands for Modified Accelerated Cost Recovery System. The Makers method actually accelerates depreciation and is typically used for personal property and not real property. So in the world of investing and investments, there are capital gains. And the Internal Revenue Code in the United States actually recognizes two kinds of capital gains, what's called a short-term capital gain and what's called a long-term capital gain. And this is different rates and is triggered based on the amount of time you hold the asset. So we'll start with long-term capital gains. An asset, when sold, is eligible for the preferential long-term capital gains tax treatment if the investor has held the asset at least 1 year and 1 day. Okay, it's not 1 year, it's 1 year and 1 day, which effectively becomes 2 tax return cycles. If you hold an asset at least that long, you will never pay a tax greater than 20% on the sale of that asset on the gain portion. Now, It could be less depending on the amount of income you earn in the year of sale. So as always, consult your tax advisor. If, on the other hand, you've held the asset for less than 1 year and 1 day, the gain on that sale will be taxed at the taxpayer's ordinary income tax rate, which currently could be as high as 37%. A lot of people have never heard of the Taxpayer Advocate. They are a faction of the IRS that's internal in the IRS, and as the name denotes, they advocate for taxpayers. I personally have had nothing but good experiences with the Taxpayer Advocate. So if you ever find yourself in a situation where you can't pay your tax, you think that what the IRS is doing is wrong, you had some other kind of a mistake, it's incumbent upon the taxpayer to contact the Taxpayer Advocate. Now, you could have your CPA or your tax person do that with written permission, but I think it's better for the actual taxpayer to do it, because if there's a problem, IRS does not provide you immunity because your tax preparer screwed up. You're still liable. So I recommend, if you do find yourself in a situation where you need an answer, something's wrong, or you need an advocate, try the Taxpayer Advocate near you. So that's a little taste of the kind of thing we do on the Friday webinars at Does It Pencil. What you saw in this video, we cover much more depth, detail, and application in Does It Pencil Course 3. If you want to join us for the webinar, it's every Friday morning at 9 Pacific. You can get the link at doesitpencil.com on the webinar page. If you want to watch more of these videos, check out our YouTube page at Does It Pencil. Thanks.